Hello, this is Carl Gong again. I've reviewed the fundamental analysis in earlier videos, and I'm going to go into the technical analysis of stock selection part 1 in this video. So, first of all, technical analysis is basically tracking stock price and volume to determine buying and selling. So this is an art that's gone on for basically 60, 70, maybe even 100 years. So they basically track prices, identify ways to determine whether the market or the herd basically is buying or selling, and they either try to get ahead of it or follow it in advance of the rest of the people in front of them. So they basically, the market is basically buying and selling stocks, and in so doing, you will see excursion where you will have lots of people selling at the same time for some particular reasons, or buying at the same time, and they tend to drive the price of the stock either up or down significantly from where the balanced position or current position is. Usually when that happens, it will reverse. People will essentially become calm again and come to their senses, and stock price will go back to normal. So what you want to do in technical trading is to identify these major excursion points to buy or sell stocks. So let me show you some of the basic techniques. You usually will get them in the charts, and what we'll do is we'll select the research, and you can use the stock research here, or you can do the market also. But if you go ahead and say select the stock and use charts, and this is the Charles website sites. Most companies will have their own website and have similar tools available. So you'll just have to find them within the various website you use for your financial management. If you select charts, you basically get this list of information from Charles Schwab. So if you're not familiar with it, they basically provide you for more frequently asked questions that you can do. These provide essentially how to do certain things within the chart. So you can review this at your leisure. We'll go ahead and start delving into it. So you can start here with reviewing our interactive charts. Select the symbol, and since I have previously used Lockheed Martin, I'll go ahead and continue using Lockheed Martin. So as you see, Lockheed Martin comes up, and you can see the various other things you can look at, the summary, the news, etc. And this specifically is the chart. So if you do company research, you can also come into what the company research, see all these selections, and pick chart. In here you have potentially different kinds of charts that you can save. So if you generate a bunch of analysis that you like to see on each stock, you can always save them. So you can save the chart itself after you've edited it and name it. So I've essentially have identified basic technology, and these are technical indicators that I wanted to review. So these are some technical indicators I've saved, so let me go ahead and bring them up. And as you see here, this will be a chart for 1 year with daily pricing. And you can change that time period that you wish to display. You can do basically all the way up to a max, which could run 25-30 years. And you can print them out essentially for different time period. So in this case, for 1 year, daily and weekly is available. If you want to take a shorter time frame, such as 2 weeks, 10 days essentially, you can get them down to the minutes and hours. And if you go much further, like 10 years or so, you'll probably not have the daily, but you'll probably have weekly, monthly. And on this particular chart, it currently has the stock of the price, Lockheed Martin, essentially 1 year from March 27th of last year to March 26th, which is today's date. And you can see the excursion it's gone through, and of course the recent down market and its effect on this particular stock. And currently I have one indicator located here. It's called the Exponential Moving Average. If you highlight this and select it, it'll give you an indicator, explain exactly what it is. It's a moving average or trend indicators that smooth stock prices movement. Compare multiple time frame can help investors spot changes in trend. Exponential moving average adds greater weight to the most recent price. And how that is done is if you do a 10-day moving average, it'll essentially add a 11th day using the latest date. So essentially point number 10 representing the current date will be repeated, and you would divide the number by the sum of those 10 days plus the extra one count by 11. So it basically adds more weight to the last reading. 50-day moving average is a very good tracking that has been used for a long time. Another one is usually adding a second tracking information that adds either a longer period to basically give you a slower exponential moving average, and you would use the crossing between the two to determine buying and selling. So let's go ahead and add another moving average in here, and we can show you how that's done. So here's an exponential moving average under the trend. Oh, again, they have 5 different things you can take a look at. There's based on the fundamentals that you can add to the chart, momentum, and trends. So trend and momentum is really what you want to look at. Volume, there may be cases where you might use the volume also, but let's go ahead and take a look at the trend again. So we'll add another exponential moving average. We have one already. We'll add another one. And what we're going to do is do a comparison of these two exponential moving average to determine buy and sell signals. So you can see it added a 20-day moving average. So the 20-day moving average follows the price of the chart much closer. You can see this particular color is the same as the other one, so we're slightly similar. And we can go ahead and edit that, customize it, and we can change it to blue, and you can change the weighting also. So maybe a little bit heavier, and we'll update the chart. So now you can see the heavier chart here showing the 20-day moving average. And you can see how it crosses the 50-day moving average. And it barely touches here. And here you can see it actually dipping very rapidly comparing to the 50-day moving average. And in the old days, we used to use a 50-day moving average against the 200-day moving average. And when we did that, essentially the crossing of the 50-day over the 200-day represents the buy and sell point. However, that was used possibly about 30, 40 years ago. Nowadays, things are moving much faster that shorter time frames are now being used so that they can make quicker decisions. As you can see here, there was one crossing here downward, which would be indicating a sell. So as the 20-day crosses the 50-day, it usually becomes a sell indicator. And vice versa, as the 20-day crosses upward past the 50-day, it became a buy point. So you would get a buy and a sell very close together here. However, if you applied it to here, you can see you would have been essentially selling out of the market right about here, or selling out of this stock at this point, which is a closing price of about 369. So if you look at this again, that's around 370 or so, maybe 380. So this would be a possible sell signal, and at this point the stock has not crossed back up in an upward moving direction, so we have not reached what would be a buy point based on the moving average crossings. So this is one of the things to use that people have done, is the faster moving average crossing downward over a slower moving average for a sell signal, and the slower and the faster moving average crossing upwards of the slower moving average as sell points, or buy points I should say, sorry. So we can take a look at this further back and see how that worked out also. So let's go back 2 years. So for Lockheed Martin, if we go back 2 years, okay, so here you can see the faster moving average crossing downward here, moving upwards here, moving downwards here, and moving upward here. So at this point, this would have been a good indicator, although you do get essentially more transition than you would like. So you can adjust the period to screen them out to get a better moving average value to determine your buy-sell signals. But in either case, this one would have gotten you out of the market, out of this stock that is, around October 29th, and would have gotten you back in on February 6th. And the price you would have been paying would have been almost $300 here as a buy signal, and as a sell signal here it was roughly 305. So not a whole lot of change, so that's why the indicator may not be as big a change as you would like. And however, if you come up here, obviously you would have been selling out at 412, so it wouldn't have been at the peak, but it would have avoided you going through this downdraft that recently occurred. So the different time frame may get you in and out, but it needs to be tweaked for each stock, because not all stock behave the same. Unfortunately, for this particular time frame of the coronavirus, all the stocks are essentially moving about the same. So all the stocks you'll see probably will have similar trends also. And that's why you have huge move in the market. It's basically an exogenous event that affects all companies, all stocks, and because of the major effect on all the stocks, we have tremendous movements in the stock market currently. Can they still be used for stock purchasing and selling? Yes. The way I would look at this is it brings the price down so that your PEG ratio will be lower and allow you the capability to pick out good stocks. Now, at this particular time with the coronavirus, the major concern is the company a viable company moving forward after the coronavirus has passed? So the uncertainty people are running through right now is it going to be 3 months, 6 months, or a year from now? And can a company cash flow be maintained? And that's the issue with our economy right now. And the $2 trillion bailout that's going through is not really a bailout. It's more of a loan to the company to help them carry over them past this exogenous event so that they can maintain their status after the event. So hopefully after the event is over, and hopefully less than 6 months or so, that the business will be the same as it was before the event. And what you would see essentially is a inactivity in the marketplace for the company during that period. But if there are fixed expenses and things they need to do to maintain the employee base, essentially, and other things that are essential for running the company, they need to put them on hold, and hopefully at the end of the exogenous event they can pick up where they left off. But that is the problem right now for many companies. They may not have the money to tide them over, and if that's the case, they will essentially not be a viable company after the event is completed. So the question is the viability of the company to move forward after the event and keep them, not necessarily keep the door open, but keep the basic structure in place and ready to turn on when the exogenous event is completed. So that being the major case, that's why all stocks were getting hit and being affected together. Some of them don't know who's going to be the winners and losers out of this. In many cases, they expect everybody to be losers, and potentially some of them will go out of business or could end up going out of business. And you will be hearing about many of the companies tapping their reserves as well as tapping their line of credits in order to sustain themselves through this event. And the government is really setting up a fund where they can provide them the money if they are not viable or if they had not had taken out any credits, so have credit available from major banks. Some of them may need billions of dollars, as you heard, and of course the marketplace may not have that money available, so the government is going to be the borrower of last resort for these companies. Okay, so this is essentially the exponential moving average, or the moving average crossing, that has been one of the hallmark of many trading in the past. It's less used so today than it has been in the past. So let's go on to some other indicators. One of the ones I would say the one I really like the best is essentially the MACD. So this is, if you were to look it up, this is expanding it, and if I were to look it up here, you have the indicators, and again this is a momentum, and you have the moving average convergence divergence, and you can see it's listed under as lower indicator. And Charles Schwab, the upper indicator is the price chart, and when they add it to the upper, they basically superimpose it. If you add it to the lower, it basically appends on below the chart. And if you have multiple lower indicators, they add it on below the previous lower indicator. So you just add on instead of superimpose. So under the MACD, and the little explanation here says you have a fast period and a slow period. The fast period is basically a 12-day period, and the slow period is 26 days, and you have a smoothing window of 9 days. And again, the MAC is the difference between two exponentially moving average and is trend and momentum indicator. It is normally considered bullish when the MACD line is above the signal line, and the more so when both are above the zero line. So generally what it's saying is if you have this where the zero line is here, and this is the histogram of the divergence here. So you see bar charts actually of the histogram of the divergence, and you see the two moving average. One is the slower moving 26 day, and the other one is the faster moving 12 days. And what is usually considered the buy indicator here is when the 12 days is crossing above the slower moving average, just as we had with the exponential moving average for the price. So in the MACD, when it crosses over, this will be considered a buy indicator. When it crosses below, down this way, that's usually a sell indicator. So you can say you have a buy indicator here, a sell indicator here, another buy indicator here, and another sell indicator here. And then again, if you keep going, you can continue to have buy-sell indicators. However, what I follow mostly is when the stock in question excessively sells off and has a deep sell volume, then it provides you a better reward to price ratio. So at this point you can see here again, if you look at the price was at this point here, and if you were to sell it, it's not much difference. It's about the same. So you really would like to see this to go above the zero line. And here you go again. You basically have a buy indicator, and this one is just beyond the lower price point here, and it has a sell indicator a little higher here. So this is what you're looking for, where you're essentially getting a low buy point and a high sell point. And you can see here it was probably a false sell point, because if you go further in time, you can see there's a higher crossover point, which becomes a better sell point. So in some cases, until it crosses below zero, you might not consider these as sell points, and you may hold off until it confirms a stronger negative trend. So here you have essentially a sell point here, and you see you have a deeper fall. And with the deeper fall, you can see it seems to indicate a stronger selling pressure. And you can see the price here, when it crosses upwards, which would be a buy point, is a local peak on the price right here. But in the process, it continues to go negative. So it continues to go stronger negative before it hits another buy point, even lower than the previous buy point. You can see this buy point here was sitting on the MACD of minus 8.6 roughly, and this buy point here had a MACD of minus 10. So the strength of how far it went down provides a stronger rebound and a better reward to risk ratio. So you can see as it moves forward in time, it created another sell point, but much higher than the previous buy point. So this point here, if we go up here, so again, the sell point here was on February 22nd, about 307. The buy point here was at 268. So that's roughly a 40-point gain, or a little over 12%. So this is really what you're looking for, is a deeper downtrend to provide you with a better reward to risk ratio. And of course, if you look at today, you can see we've taken a fairly steep decline here, as you might have expected. And it looks like we had just almost gone to zero on the divergence. So it looks like the faster moving MACD line is just crossing over the signal line, which is the slower moving one. And so this is a possible good indicator that you can start nibbling on this particular stock. And your risk is possibly downward a little bit, but your reward is much higher. So you could have potentially a big bounce off of here that might go back to where it was. However, even if it hasn't gone all the way back up, you do get the recovery, so that's a good thing. So the strength here is what I consider a very good indicator that your reward to risk is going to be in your favor significantly compared to any other time. And as you look at the price, you can see there are some positive trends and negative trends here that you could play off of. However, if you're in it for the long haul, this is what you're ideally looking for. This provides you a great reward to risk ratio, that you're taking such a deep decline that when it does get back to normal, it could take anywhere from 3 months to a year. You would be in better shape at that point. Imagine the stock at this point right now, in a year's time, get back to the original peak. So you could go be from essentially what looks to be about 350? It says 320 or so. So at 320, you could potentially go up to 420. So that's 100 points, and that would be about a 30% gain. So I'm sure everybody would be very happy with a 30% gain in a matter of a year. Even if you did it in 2 years, you would still be happy with that. So that's why at this point, it's a very good time to be buying. And what you're going to find out is many stock will show the same configuration as this. because, of course, the exogenous event is affecting all stocks. Other indicators, besides the MACD, there's the relative strength indicator. And the relative strength indicator basically looks at as a momentum indicator, which measures the strength of price change relative to prior moves. And this is an index that I believe was used by Merrill Lynch back in the 1980s when I was with them. And they would have essentially major reports out on the relative strength of various companies. And what they're comparing it is this company price change relative to all the other companies at the time. The ones that have the stronger relative strength or relative price movement is essentially a higher ranking, and they usually rank it from 0 to 99. And usually when they're in the 99 range, they're probably considered overbought. So you basically can see this movement here, and this is the 50% line, and you can see the relative strength is considered overbought when it's above this line, and that value they're using here is like 60, 70, looks like 70% or 70 value, and below here it's like 30. So above 70 is considered overbought, below 30 is essentially oversold. And again, you're looking for the stock to migrate between 0 to 99, and it makes the excursion. And you can see within a period of a year, it could make multiple excursions back and forth. So you're looking at the stock transitioning up and down relative to the market. If you look at it relative to itself, that's what the MACD does. It looks at it relative to itself moving up and down. And another indicators that are very similar is the stochastic that looks at the move. And again, the stochastic shows period where stock is overbought or oversold. And you can see they provide similar information as the RSI. And you can almost see that the events also lines up with the MACD. However, the overbought and oversold indicators here don't tell you the strength of it. It only provides you that it's in the zone of overbought or oversold. And that's why I prefer the MACD. You get a little bit more about the strength of the overbought and oversold. So here, for instance, you can see it says it's overbought, so you don't know where to sell in the RSI or in the stochastics. Versus if you look at the MACD, you can see it seems to have peaked around this area, so you might consider selling as it dips down below the slower moving average. So again, if you look at this here, you can see that corresponds quite well to a local peak. And then again, you get a little trough, not a very big trough, but a little trough. And it provides a launching pad essentially for a long bull run until you get to this where you get another little drop. So if you're very bullish on the company and you don't see anything problem with it, these are just excursions that goes on all the time. But with the bigger excursion, you might consider, such as this one here, taking a little profit as it drops off the peak. If you set a lower level here, anything above 5 for instance, then you might have sold here. You probably wouldn't have bought here because you would want a deeper drop in selling to have a buying opportunity. So you might not have had another opportunity to buy it again, but if you held on to it, this would provide you another selling opportunity here. And now that we have this big drop, it provides you with a strong opportunity of picking it up if you had interest in it. So this is my basic technical analysis, you can view many other indicators and play around with them and decide what works for you. But in the next video, I'll apply this on many charts so you can see how it's worked. Hopefully this provides you with a good introduction to technical analysis and how to use it. And I hope you find this very useful. Thank you.